In this video, we're going to trade Bitget futures. I'm going to show you how to enter orders onto this system, how to use all of these different order types right here, and how to manage all of your futures trades, including thinking about leverage if you want to use that, and a futures trading guide in general. I'll leave the timestamps for everything down in the description. We can come to the Bitget trading system then. Firstly, if you want to make a deposit, you can do so in both crypto and fiat currency. I'll leave a link down in the description to a deposit bonus, I think up to $9,000. So if you are new, check the details via the link in the description. You can make a deposit right here. Now, if you want a beginner's guide for Bitget, I'll leave that linked down below as well. It goes through navigating the system and getting crypto and fiat on and off. But a deposit right here, you can deposit any crypto, for example, US dollar Tether, and then choose a cheap chain to transfer it in from a different exchange like Binance Smart Chain or something like that. And you have your deposit address here. You can just send that in from a different exchange. If you want to deposit fiat currency, you can do that. It might be not available in your region, so just check in your region if it is available for a fiat currency transfer. To get to the futures trading screen, just go up to the top, click trade, and then choose the specific futures that you want to trade. These are slightly different. We'll go through these differences in a second, but we obviously need some assets into our futures trading account. What you can do is press transfer right here, and I'll just show you actually within the system. So if you go into the futures trading screen, we can just go down to the bottom and click transfer. It's a lot easier like that. I have some assets in my spot account, so I'm going to transfer in some US dollar Tether. Just going to click all right here. You can see I've got $100, so I'm just going to confirm that, and that transfers internally, so it's instant and free, and then you have some assets in your account to go ahead and trade. Futures are known as a derivative, and that's because they derive their price from something else. So in the case of a Bitcoin futures contract, what we're actually trading here is the price of Bitcoin. So we're not buying and holding any crypto whatsoever. This is just a synthetic derivative of the price of BTC. And so this is much more suitable for trading, day trading, short-term positions. You can trade the price of Bitcoin or Ethereum or anything else. And so with futures, you have options that you don't get when you buy and hold. You have the ability to buy long, which is essentially taking a position that benefits when the price goes up. So you buy low and sell high. You also have the ability to sell short, which is benefiting from the price going down. So again, you buy low and sell high, but you just sell high first, looking to buy low later. And so you obviously want to sell short if you think the price is going to go down. Now that's different to spot, where you actually buy and hold the crypto and you have to buy it first. And then if you want to sell it, obviously you need some crypto there to sell. With futures, you don't need any holdings in order to take positions on the price. So that's the first thing. The second thing is, as we can see here, we have the perpetual contracts. Now on Bitget and most other exchanges, what you're going to get is what's known as USDM, which is US dollar margined. You can see here, this is USDTM. So the stable coin that we're using is US dollar Tether. And that is what the contract is priced against. So we have all of this BTC, ETH, you can see all of these cryptos here, and the base currency, the quote currency and the currency that we're using as collateral is US dollar Tether in this case. We can also see if we go over, we have USDC margined. This is US dollar coin. If you want to use that as collateral and you have that in your account, you can use that as well. As you can see, only two right here. Most people will trade US dollar Tether margined. So important when you're trading a derivative, like I said, we're not buying the crypto. And so the assets that we have in our account are used as collateral for our trades. So think about it as the money that you have on your account is really just there to pay for losses. So you're not buying a certain amount. You can obviously use leverage, which is where the exchange gives you a certain amount to trade with. So that collateral that you have in your account is simply there to pay for losses in the trading account because you're not buying and holding any crypto. So we'll go through using leverage and how that works in a second, but we have the collateral there, either US dollar Tether, US dollar coin, or coin M is actually where you use the value of a crypto to have as your collateral there. So which one should you use? Well, US dollar Tether is the most popular. Most people will use a stable coin as the collateral because that collateral value doesn't change, right? That's the underlying quote currency. And so you know you have $500 there. That's always going to be $500, and you use that $500 to pay for any potential losses. However, if you use coin, This is, of course, a risk asset, and this can go up and down in value. And so this can be more risky. For example, if you're going long Bitcoin and you have Bitcoin as collateral, let's say the price falls, well, your position is now going to be in a loss, but also the value of your collateral underpinning that is going to be going down as well. And so it's considered more risky for sure using coin as collateral rather than dollars. And so most people will use dollars. However, if you're extremely bullish on the price, or you just have BTC there and you want to maybe, take a small leverage position on 1% of it or something like that, you can do that. But obviously having a risk asset as collateral is definitely more risky. Most people will trade US dollar Tether or USD coin as that dollar collateral value. A quick overview of the futures trading screen. If you are thinking about trading futures, you've probably traded spot for a while. Anyway, there's some differences here. So we have the perpetual futures here, called perpetual because they never end. In traditional markets, most futures actually have an expiry date. With crypto, these are perpetual futures. They don't have any expiry date, so you just trade them as they are. So there's no, March expiry or anything like that. It just carries on forever. What we also have here is the mark price and the index price. Important because the mark price usually is the actual contract price on the system, and this can be different from the price traded in the market. Why that's important is because sometimes you get very volatile moves where the price of something will move in a certain direction and then back up again or whatever. Now, that's the traded price in the market. However, the mark price of the futures contract may not trade at that. And it's important because sometimes when you trade, a lot of these liquidation levels, if you're getting liquidated, or your take profit and stop loss levels may actually go off the mark price and not the market traded price. So I see it online a lot where people say, hey, this futures contract traded at a certain price and my order didn't go through, so they've done me wrong. Well, actually, the mark price is usually the thing where you actually get those trades at. So if the mark price doesn't get down or the same as the traded price in the market, that's an important thing to know before trading. It's the mark price that most trades and stop loss levels and liquidations are traded off. We also have the index price right here. The index price is the price of, in this case, Bitcoin futures across major exchanges. So this is important because each exchange essentially has its own market because this is a derivatives price, right? So the index price is what Bitcoin is trading at right now across major exchanges. That's important because all of these exchanges have slightly different markets. And so the index price is important to make sure that all of the futures contracts and everything try to be exactly the same across all different exchanges. We also have the funding rate right here. Funding is something that you're either going to have to pay or you might actually receive it, and you don't get this in the spot market. Because crypto futures are perpetual, what happens is the price of those futures right here may actually be slightly different to the price of Bitcoin because it's a derivative of that. Supply and demand in the futures market may change this price. So what this funding tries to do is incentivize the market to take positions, either long or short, that force the futures price to be as close as possible to the actual price of Bitcoin in the market. And so as you can see here, the funding rate is positive, and that means people going long in the market are going to have to pay a funding rate to short sellers, because in this market, for every buyer, there is a seller. And it's buyers versus sellers right here in the futures market. So what we have here, as you can see, is that when the funding rate is positive, long position holders will pay short position holders. So if you're going long, then you'll have to pay this right here, this funding rate. Now, as you can see right now, the funding rate is around 0.0096%. And I think there's a funding every 8 hours. So you can times that by 3 to get a day rate, and then times it again by 365 to get a yearly rate, and you're looking at around 10.5%. So if you had the futures position open long for an entire year, you would be paying 10% of the price of that out in a funding rate. And so you have to keep that in mind. If you're trading short term, it's going to be a small amount. It's not going to matter that much, but it's important to know. Now, if the funding rate is negative, people taking long positions will actually get paid this funding. And this funding changes dependent on where the market is. If the price of the contract is above the spot price, then it's going to be positive. If the price of the futures contract is below the spot price, it's going to be negative. So you should take this in mind. However, this can change. You can see it's changed already dependent on the price. So keep it in mind that a few percent or so may be having to be paid out on your position. It's not going to make a huge difference, but it's just something to keep aware of. Trading fees on Bitget futures are 0.02% for maker orders and 0.06% for taker orders, mostly in line with the industry. There are some cheaper exchanges out there. I think Binance is a bit cheaper than this, but obviously dependent on what country you're in and restrictions, you might not be able to use it. So they're within the ballpark. Now, what are maker and taker orders? I'll explain that when we get to the different order types. We'll come on to the different types of margin or leverage that you can use though. Now, you don't have to use leverage, and I cannot recommend anyone use leverage. It increases risk most of the time. However, we're going to go through some steps to mitigate that risk and make sure that you're not getting wrecked and taking too much leverage that you don't want to. But there's two ways to margin positions. So what we're going to do is come up to the top right-hand corner. You can see this right here called isolated, and then there's cross. What is the difference right here? You can change between them pretty easy, as you can see, cross and then isolated. Now with isolated, you get these two boxes, and with cross, you don't, as you can see. So what's the difference right here? I'm going to click on long. So we're on isolated margin right now. What isolated margin means is that, like I said, you have a balance in the futures trading account, and that is used as collateral to pay for any potential losses and any leverage that you may be taking. So with isolated margin, each individual trade that you take will have its leverage position isolated from all of the other positions that you take. So for example, if I have one trade that is long Bitcoin, I have to put the collateral into that position, and it is cordoned off from everywhere else. So you can change that to whatever you want, as you can see right here. Let's just put it on 5. And then confirm that. And you can change that leverage, the default leverage that you take per position, for long positions and short positions. Now, if I have a different position, for example, short Ethereum, long Ethereum, the collateral that is used to fund that trade will be different than the Bitcoin position. So they're different from each other. That reduces risk a little bit, because if the Bitcoin position blows up, I've still got leverage over for the Ethereum position, and they're not mixed up. And you can do it per long and short. With cross margin, essentially the collateral that you have on account is used to fund all positions. This gets a little bit messy, because if one position is doing well, the other position is doing bad, that one might get liquidated and take the other position. So most people will use isolated just to cordon off the collateral they're using per position, but it's up to the individual trader. When trading futures, you can open positions and close positions. If you haven't got any positions as yet, and we have none down here, you can, of course, open a new position. And you can add to those orders as long as you've got enough collateral to pay for everything. So if you want to open an order to go long, you can do that. You can then keep it on open. You can buy long again, and you essentially add to the long position that you have. Now, what you can also do is close. And let's say you have a long position. You can see here it changes to close short. So open would be buying long right here, looking for the price to go up. If you have a position, let's say you have $1,000 in the position and you want to close a percentage of that, just go to close, and then it goes over to close short right here. So let's say you want to, close 25%, 30% of the position. It just reduces that position size by essentially paying back some of the leveraging collateral that you're using, if you're using that. So you can open and close. You can close percentages of that. We'll get to that when we edit some of the orders that we put in on the system. With futures, you can trade with different order types as well. So we have the normal market and limit orders, assuming you know what these are if you're wanting to trade futures. So market order right here, limit order where we choose the price. Now that's important, like I said, with the fees, maker taker orders. If you are using a market order, you are a taker of liquidity. That means that you are taking someone else's order right here. These are people's orders that they put on the book and that they show to the market. So they're providing liquidity to the market. If you're taking their order off the order book, you are using a market order, you're taking their liquidity. Now, exchanges don't incentivize this, and so you get a higher trading fee. So you'll pay a higher trading fee there. If you want a lower trading fee, you can go to a limit order and you can make liquidity onto the order book. That is putting an order, if you're a buyer, down below the current price, putting that order in as a limit order, and you're making liquidity onto the order book. So you're getting cheaper fees like that because they try to incentivize more liquidity onto the system to get those orders there. Now, what you can do if you don't ever want to pay taker fees is to go up to this order type and click post only. What this is going to do is give you a limit order. It has to be a limit order because you have to be a maker of liquidity to get those fees. But what this is going to do is, let's say I want to put an order in at 26,450. I can do that because it's below the current market price. So I'd be making liquidity as a buyer here, down here on the order book. And that can go through and I can do that trade because I'm using a limit order. However, if I put a limit order in that's above the current price, then that's going to go through, right? So if I put in an order in of 26,700, something like this, I can put that limit order in and it's going to go through straight away because I'm telling the system, buy me crypto, and the most I'm willing to pay is 26,700, and it sees the order book and it says, well, I can get you a better deal than that, so I'm going to trade straight away. What it's actually going to do is lift the best offer or the ask right here. And so that's basically a market order at that point because you're taking someone's liquidity off the book. And so you're going to pay those higher fees. So what you can do if you don't ever want to do that is just use a post only order. And if your limit order is going to trade straight away, so you've put in a limit order that's above the price if you're going long, what post only will do is cancel that order, and it will just say, hey, your order is basically going to go through as a taker order, you'll pay those higher fees, so we're going to cancel it for you. So if you do want to do that, you can use post only orders, which are limit orders away from the price, and if they aren't away from the price, then it's going to cancel the order for you. Bitget also allows us to use stop orders, so we can use these as a stop loss if we want. These are known as trigger orders on Bitget. So if you click trigger here, you might know it as a stop order. And as you can see, we can put these in. So what is a stop order? A stop order is an order that triggers at a certain price, and you can use this as a stop loss rather than a limit order. So as an example right here, let's go and draw a horizontal ray. And we're going to put a limit order. So we have a long position in, and we're going to sell at around this price, which is 26,055. So what we could do here is, if we put a limit order in, let's say we're long, and we want to close, and we're going to close that short at 26,055. What this is going to do is trade straight away, because what we're saying is, close the order with a limit price of 26,055. And the price is above that. So the system is going to say, you want me to sell, and the worst price that you want to get is 26,055. The current price is 26,500. I'm going to sell straight away for you. Well, that's a sell order, basically. A stop order is different, where what you're saying is only trade if the price gets to this level. So with a trigger order, what you're saying is only if the price gets to 26,055, then put in a market order or a limit order at whatever price you want, 26,055. So this acts as a stop loss, because what you're saying is don't sell unless the price gets down here. So this is different, because what you're saying is down here, that's when I want a stop loss. So you might be making a loss at that point, but only then do you want to sell out to stop any further losses. That would be a stop loss order. If you used a limit order, you'd just sell right now, which may not be what you want to do. So a stop order or a trigger order right here, when the price gets to this level, enter this order like I say. So you could put a sell order in here at like 30,000. And what would happen is, if the price got to this 26,055, the market would then input a limit order to sell at 30,000. Now you wouldn't sell anything there because the price is 26, and your limit price would then be 30 above the price, and it wouldn't sell. So there's a massive difference between a stop order, which is only when the price gets here, then input this order as I tell you, rather than a limit order, which may trade straight away. So this can be used as a stop loss, where you have a position, you can come down, and you might be making a loss, but you stop any further losses. And that's important for position management when we're trading futures. Bitget also allows for trailing stop orders. These are most of the time used as a sell order to either sell at a specific loss or to actually sell and take profits. And so what happens here is that the trailing order follows the price by a certain percentage. Now onto the long side, if you're long, you can follow the price up to a certain percentage, but when the price comes down, the trailing stop doesn't move. And so this essentially locks in profits if you're in a profit in your order. So if you come to trailing stop here, what happens is this is like a trigger order that we've just seen. So we can see the trigger price right here. So let's say we're long 1 Bitcoin and we're in a good profit and we're kind of finished with the order right now, but we think the price might go up. And so we're happy to follow the price up. But if the price does start coming down, we don't really want to, lose that profit that we've had in the position. So let's say the trigger for this order is 26,500. So when the price gets there, that's the trigger to enter our trading stop. So the callback rate right here is the amount in percentage terms that the sell order, in this case, because we're going to be closing along, so we can close that. That's the percentage where this sell order is trailing the price. So you can put that as like 5%. So what we're saying is at 26,500, we are going to enter an order that sells our position at 5% below the current price. Now, what happens is, as you can see here, the trailing stop will trail the order by 5% to the upside, but when the price moves down, it doesn't stop. And so this is essentially trying to lock in profits if the price is coming down. So what you can see here is you have an order entry for the trailing stop right here. The callback rate in this example is 5%. So the sell order is 5% below. So what happens is when the price moves up, so does the trailing stop, and it trails upwards, and it's still 5% away from the price, even though the price has moved up. As the price moves down, the trailing stop does not move down, right? So it's trying to lock in any potential profits there. The price moves up again, and so does the trailing stop to keep the callback rate 5%, which we've chosen. And as you can see, the price moves down again, trailing stop doesn't move, and eventually it falls 5% and hits the order and we sell out. So a trailing stop is kind of to lock in profits. If you're finished with your order and you say to yourself, actually, it's time to take profits right now, what you can do is put a callback in that says, let's just trail the order by 3%. Even if it falls 3%, I've still locked in a profit, but if the price goes up, then we can follow that up and might make a few percent on the upside as well. So trailing stops are decent if you're essentially already in a profitable position and you just want to maybe take a little punt on whether it will keep going up, even though you're happy to take profits within a few percent. How do traders use leverage with their trades to make sure they know how much risk they're actually taking? So again, I can't recommend leverage and don't recommend it, especially for beginners. It's usually just increasing risk most of the time. So I can't recommend it to anyone. We're all obviously able to make our own decisions. So I'll just show you how traders, will try to manage this in terms of what is the risk that they're taking for an order. So right here, I've changed to 10x long and short, as you can see, just to make the maths a bit easier. And what we can do here is understand that traders may risk 1 to 3% of their portfolio per trade. So if they've got a $1,000 portfolio, they may be risking $10 to $30 if the trade moves against them. How do they know that they're going to lose that? Well, you use a stop loss, and you do that through long and short position calculators. So what we're going to do is just a sample long position. And we want to go long here, so that is the current price. Now, what we're going to do is move this stop loss to a level where we think that our trade will be invalidated. So there's many different ways to do this. Technical analysis, looking at the charts. I've got, a load of free videos on YouTube that go through that, which I'll link in the description. If you want to look at the Crypto Investor course, which I'll link down in the description as well, 300 plus videos there, huge trading sections, huge futures trading sections about managing risk, really in depth. So if you want to check that out, the link will be down below. But as an example here, we have a potential stop loss here and a potential take profit here on that long position. And we are looking at that because of our technical analysis. So as we can see here, we have prices now on the chart that we can look at, and we know exactly what our position at risk will be. So we have these orders here, and then we can just input that in a trade calculator. So the entry price right here is 26,494. The stop loss would be 25,792. So we can just enter this in and we can find out how big the order is that we can take. So let's put this into a trade calculator. I'll leave this one linked below. You can search for one on Google anyway. So Bitcoin US dollar, and the open price right here we're going to put in. So that's 26,468. The stop price on a long position would be below our entry, so 25,792. 25,792. How much of your account do you want to risk, right? So if you have 1,000 or 100 in, you want to risk a certain amount. So let's say 2%. You can also do dollars on this one. Calculate that. What this is now giving us is the size of trade that we can enter to put 2% of our account at risk. So if you go back, you have these prices in. The take profit doesn't matter as much. It's really just you need to know what your risk is so that you can size your position accordingly. So what we know now is that on that account, we can trade this lot size, which is 0.002 or 0.003, right? So we come back and we put this in. So that would be 20. Let's just do a market order, but we can put obviously our entry in here. And then what we can do is go to the unit, and we want to put this in as quantity right now. You can choose dollar amounts as well if it's easier for you, as you can see here, but we're going to go to quantity because what we're seeing is that this is telling us the exact quantity. So 0.003, something like that, 0.003. And you can see that would be roughly a 2% loss on our portfolio if our stop is hit. So we know exactly our stop in terms of percentage drawdown. This is just telling us the size that we can go to make sure that we're not risking more of our portfolio than we want. The main thing when trading futures is just to make sure that the liquidation price is nowhere near your stop loss price. If it's near or above, then you've got an issue. Liquidation isn't a huge issue if you're managing the size of your positions well. However, if you get liquidated, you pay much higher fees. You pay a liquidation penalty and everything like that, which may not be the end of the world depending on how much you're trading and if you're over leveraging. So what we can see here is that Bitget actually works this out automatically for us, is that if we're in a long position for this amount, the liquidation price would be 23,957. So we just have to make sure that that liquidation price is not above our own stop loss price, because if it is, we'll get stopped out before, or we'll get liquidated before our actual stop loss. And so that's obviously not good because we've mismanaged that trade. So as long as this liquidation price, 23,962, is below what we have, we're all good. Now, using leverage can be changed here as well, because what we can do is go to an order calculator, which is right here. And what we want is, you can do liquidation price. You can also do P&L and target price. We can work out what the liquidation price will be. So we can click this. We have isolated margin long 10x. We're going to go entry price right here, which we know as 26,468, 26,468. We also have the quantity of BTC, which we know is 0.003. And then balance right here. Put your account balance in, and then calculate that. Liquidation price 23,916, which is more or less the same as what it told us here. So what we can do is increase leverage, and we can see how that works. So let's increase to maybe 20x, and let's go calculate. And the liquidation price is 25,245, which is still below our stop loss price. So what you can see here is that you can actually use extra leverage and still have the liquidation price below your stop loss price, which is absolutely fine. So you can use that extra leverage without taking any more risk. What are you actually doing? Well, all leverage is it just lets you put less money down for the trade. So the trade size is exactly the same, but you're just putting less money down in that trade. So that leverage is no different between 10 and 20. You're just putting less money down into the trade. So if you're managing risk like I've just showed you, your risk is exactly the same. You're only risking 2%. And this leverage is pretty much irrelevant at that point because you're risking 2%. You're just making sure you're not getting liquidated. You can put less money down in the trade. If you're trading very large amounts, hundreds of thousands, millions per trade, this becomes very relevant because let's say you're trading Ethereum, you've got millions of dollars in your portfolio. You want to put as much of that into staking as possible because you're getting 5% yield currently. And so you want to put less down into trades just to have less risk on centralized exchanges and to have more yielding less in these trades. If you're trading hundreds of dollars here and there, it's irrelevant because you're looking at the difference between $10, $20, $50. So leverage in that instance isn't obviously that important. Where leverage gets more relevant is when you're taking slightly more risk and then the value of your trade actually exceeds what you have on account. So we're going to use 10x leverage again. And what we're going to do here is just increase the amount of risk that we're taking to 5% of our portfolio. So if you have $1,000, you're risking $50 on that trade for where your stop loss is. So we're going to do this again and we calculate this and now we can trade 0.007 BTC. So we're going to go back and we're going to enter 0.007. And you can see with 10x leverage, the cost of this order is around $19. And with 10x, we know that the position size, the actual value of the trade in the market is going to be around about $190. So we're putting 10% of that down. So $190 is almost double the actual value of the money that we have on account, right? And so our trade size is now bigger using leverage than we could possibly imagine without using leverage. So what we're going to do is go over to the trade calculator again, go to liquidation price. Entry price is exactly the same, 26,468, 26,468. We have the quantity of Bitcoin, which we now know is 0.07, and the balance, we'll just put $100 on account. Calculate that. So the liquidation price on this long 10x leverage is 23,916. So again, it's still outside of our stop loss. So we know that we're stopping our loss before any potential liquidations. What we're doing here is now trading with more money than we actually have. But we are taking more risk because of that. We're now risking 5% of our portfolio to the downside rather than 2%. So leverage, you increase risk, you increase position size, you increase the amount that you can lose given the same price movement in the open market. How to actually enter positions then, we'll just go through the market order. Open market, we're going to trade 0.003 BTC. We know our liquidation is 24,000. This order will cost us around $8 with 10x leverage. So the order size, the actual value of the trade should be around $80 or so. What we're going to do is press this and we are going to long with a take profit and stop loss. Take profit isn't as important, but we're going to put the stop loss in here and our stop loss is around 25,500, something like that. You can see the expected loss would be 37% of the initial amount that we've put in, which is obviously quite a lot considering a small move because we're using leverage, right? So the expected return, you can see that if that order gets taken. We won't put a take profit in for now, but we can buy long. The cost of that order is $8. And you will see right here, if we buy long, should check the order, can see that. And we're just going to press confirm and then that goes in. So what do we have right here? We have a position which is valued at around $80. So that's around 10x what we've actually put in cash as collateral to fund that position. Down in the order screen, we can see all of the details of our order. We can change everything. So we have the position size, which is $80. That's the actual value. Position margin rate is 10%. So we've got 10% down of the order. Liquidation price, 23,940. So that is below our stop loss at 25,500. Just different details right here. We can change the take profit and stop loss orders. So what we'll do is put a take profit here of, let's say, around 28,000. And we're going to put the stop loss in around 25,500, something like that, 25,500, which is, more or less what we've got here. Press confirm. You can see these orders in. So it will put the take profit and stop loss orders in and change them for you if you want to do that. So you can press confirm and it changes the orders. Now we have the take profit in and the stop loss. You can just X out of that. That order cancels right there. So we just have the stop loss in. What you can also do is adjust the amount of leverage that you have in the position. So we have 10x leverage, which means, it's 10x, the position size is 10x bigger than what we have funding the losses. So what you can do is adjust it and actually move it down. So if I move this down, what it's actually going to do is just put more money locked up as collateral. So I'm going to move this to 5x. And what that should do is increase the amount of collateral that I have. So I'm going to press confirm. Now what you can see is that nothing's changed with the order, but I've just put more money into that order as collateral. And so this works if you're getting close to your liquidation price and you're like, no, I actually want to see this trade run out. You're going to put more collateral in there to make sure that you don't get liquidated. But it doesn't change the order size or the value of the order. It just changes your margin rate. You've put more money towards it, and that moves your liquidation price way down. Like I said previously, we can close the order. Now you can do this partially or in full. So if you come down here and press close, you can see this and you can edit this as you want. So this essentially closes the whole thing. But what we can do is actually come up here and press close, and then we can close short with, let's say, 0.0015. That would close a partial amount of the order. So we could, let's say, 0.002. That would close 0.002 of the order. We have 0.003 in order size. So we could close. What that does is just take the actual value of the order down, right? So our position size moves way down. If you're in profits, you might want to close 50% of the order to kind of take, you know, profit and position out of the order that you've got. And so you can close that short either partially, or you can just come down here, close the order right here, or flash close. Flash close is just a market order which says, you know, get me out of everything, and it bang, and it just hits the book. You're going to be paying those taker fees, but it gets it completely wiped out for you if you want to do that. That is trading futures on Bitget. If you are new, check the deposit bonus link down in the description. Much more in-depth videos I'll leave down there, and the crypto course as well if you're interested. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.